Apple got down to a under 16 PE ratio like 10 plus years ago. People were kind of dismissing Apple for just a little while, for a year or so, and they kind of dismissed Apple and it didn't do very well. And since then, it's had a 5-for-1 split, a 2-for-1 split. I mean, it's like if you had bought Apple right then, you'd be doing really well today. And I kind of feel like NVIDIA, like these big name companies are the best in what they do and the best in the world. I'm not at fear.
All thoughts and opinions shared in this recording belong to the participants. This podcast is meant to inform and educate and should not be seen as solicitation or endorsement for business.
Welcome to the Market Moment. This is Matt Walters, and I'm here with John Martfeld.
Morning.
And Eli Freeman.
Good morning.
And today, we're going to talk about what happened yesterday in the markets primarily. So before we jump in, what's good, guys? Anything worth mentioning?
Man, the Kansas City Chiefs and the refs are so happy about this weekend. They've moved on to Super Bowl.
Well, so
that's a big deal.
Considering like 95% of Northwest Arkansas loves the Chiefs, we're not going to bash the Chiefs.
Oh, no, I'm not bashing the Chiefs. I'm very happy for them.
Well,
I'm very happy.
Yeah. I'm not. But we probably shouldn't go too far down that.
No. I'm rooting for them to beat the Eagles. I think this is great.
Yeah.
They, So anyway, but that was a big deal around here.
It was a great game.
Yeah.
Great game. So anything from you, Freeman?
Nope.
All right.
He's staying clean of all that. All right.
Okay, so yesterday, big day in the market. It's kind of a fun one, right? So we saw DeepSeek. That's what it's called, right?
These names are getting more creative.
Yeah, I know. It's like a giant blue whale is their logo. So DeepSeek is a Chinese AI company that came out and basically said like, hey, we built this AI, and this stuff is so far over my head in terms of understanding like the structural components and what's actually happening behind the scenes. But they basically said, hey, we came out and built this, and we did it for less than $6 million, and it's better than what you guys have.
Yeah, 10% of the cost, 10% of the time to do it, and all that stuff.
Yeah. And it's like free or really cheap, and so it spooked all the AI related stocks primarily. Especially Nvidia. Nvidia I think was down 16%, something like that yesterday. So that was a big move in the market with Nvidia playing such an important role, in the S&P 500.
Such a big move. Nvidia was down $590 billion, which is the largest single day market cap decrease ever. And if I remember right, it was somewhere around, that is the market cap of 480-ish companies in the S&P 500 that it just declined yesterday.
Yeah, so those companies would be out of business.
Yeah.
Based on the
completely.
Value. Yeah.
Sounds like a fantastic opportunity because here's my thought on all this stuff. How many firms are going to drop NVIDIA for their AI support or whatever and go trust a Chinese company to do that for them? How many subscriptions are going to be lost to a Chinese company? So my point is like, you can't trust that. You can't believe anything. I don't believe anything I hear.
Well, I think they're using NVIDIA chips.
They are. They're using NVIDIA chips.
Like,
just
so
less so.
It's still.
That's the thing is like, it's not even, I think NVIDIA selling off was interesting because it's not even a direct threat against NVIDIA as it might be.
It's just
more
the whole
so
AI
against,
sector.
Like Meta and Google and some of these people who are building out the AI. NVIDIA's selling DeepSeek. DeepSeek.
Yeah.
NVIDIA chips as well. So I don't know why the market got so spooked specifically with NVIDIA, but
here's my thought on why the market got spooked. We are extremely highly overvalued on the market, extremely high. We've had this incredible run for a long time, led by AI stocks.
But what is overvalued? If you look at, and Eli, I don't know if you have this or can pull it up, but if you look at like the PE ratio for the Mag 7,
right,
versus the PE ratio for this S&P 500 X Mag 7,
right.
It's two very different.
No, it is,
two
but
very different stories. So I think what me and Eli were talking about this yesterday. I think yes, when you just take the S&P 500 average PE, it's high.
Yeah,
right.
yeah.
But if you carve out and actually look at why it's high, it's because of what we've been talking about for the last 3, 4, 5 years. These handful of big tech companies, AI related companies.
Yeah.
So it doesn't mean that the rest of the market wouldn't sell off if we saw those come down.
Right.
But
right.
I don't think it's unrealistic to think, hey, we could see a pullback in some of these big tech names with the rest of the market not feeling a majority of that.
Yeah,
because
which is kind of what happened
that's
yesterday.
Where so much of the froth. It's exactly what happened.
Yeah, it happened yesterday. So, yeah, you're right, and that the overvaluation of all of these tech names, it reminds me eerily of 2000, when every tech name, and we thought, and the rhetoric was that we were in a new technology boom, and there was no worries to worry about fundamentals or look at a stock valuation. It was not, because it was a new market. And I remember those terms being thrown around all the time. Don't worry about it. It's all good. Tech stocks are going to continue to fly. And then we went from 5,000 on the NASDAQ to 1,000, pretty fast. And it was tech stock generated.
Yeah.
Right? But they drug everything down.
The difference, though, because we're going to play good guy,
Good
bad
cup,
guy.
bad cup.
So the difference between that and this is the areas of the market today that have all the froth, right? The extended P ratios, overvalued, have driven the performance, have real cash flows and profits and businesses, right?
Yeah.
And a lot of the other market doesn't have that froth. If you go back to 2000, everything was trading at insane multiples, and half of the publicly traded companies weren't even profitable or didn't have material cash flows. Like, there were these companies that came out, these internet companies that came out as small cap,
shoe.com
and just exploded.
Yeah.
And you don't have near as much of that today as you did back then.
No, you don't. But we're trading heavily on this AI story. That AI is, where was AI 3 years ago? Where was AI 10 years ago? We have traded the last 2 years like AI has this been invented in the last 2 years, and and you can't get enough of it, and everybody can't get enough of it, and eventually you overhype these stocks, and eventually they get a little bit higher price.
As long as earnings don't grow.
Well, right, but to your point, here's my thought on the markets in general. So again, historian. Go back to 1980. The average PE ratio when Reagan won the election was 8. Average PE ratio on the stock market. That gives you a lot of runway for all stocks to perform well, right?
Yeah.
If you're
big industrial society.
Yeah, you're very. But they were severely oversold in 1980. Today, the average PE ratio is 28, largely driven by overpriced or not overpriced necessarily, but overvalued tech stocks, over AI stocks. So my point is, when you have in this kind of news, Chinese has this thing that's going to, take over the world and be cheaper and all that kind of stuff. I think any little news that creates a little bit of fear will create a sell-off. Mm-hmm. Because of the overvaluation. I think big money looks at this and says, hey, there's going to be a point where we're going to have a pullback. But I also think, today, I'm looking at NVIDIA's price. I'm like, this is a great opportunity. If you believe in the company and you think they're still valid and still going to do everything, which I do, then you get it at a deep discount from 2 days ago today. So I look at opportunity, not necessarily that I'm worried that this is going to continue. Mm-hmm. I'm like, hey, great. We just created a nice little opportunity for buying.
So, charts guide.
Yeah.
What do you have?
So you get to equal weight S&P price to earnings is 21. So you look at across the market. If you're to say, okay, I take out the market weighting of these large tech companies, we're not at an expensive time now. A little bit more expensive relative to history, but profit margins up 8% for S&P 500 companies last year. There's some expectations that the market's going to shift with looser regulations from the Fed, the Trump being pro-business in a lot of ways. So there's a lot of expectations, and to your point, John, I think there is a lot of excitement around the tech companies, causing NVIDIA currently trading at a 40 price to earnings. Now that's after a pretty massive sell-off. But
yeah,
you talk about the company that has outperformed every company basically for the last 3 years. And a 40 PE sounds completely normal.
What's crazy is a couple of years ago their PE was 300. Yes.
Right,
that's so
future.
Well, some of that is okay, they've grown and proven that a lot of that valuation is justified because their earnings have caught up with the price, relative to what the PE was.
There's two ways a stock PE goes down: as a price, your earnings go up, or your price goes down of the stock. Right?
Yeah.
That's how the PE ratios get back in line.
Right.
But I look at even going further out and look at Walmart's PE. Walmart's PE is the highest I have ever seen it. Mm-hmm. Now, is Walmart a tech stock? What's the story with Walmart, right? And I don't disagree that Walmart has great things on the horizon, and they're fantastic companies. That's not the point. But when I see that scares me more, honestly, than seeing NVIDIA at 40, because NVIDIA at 40 is based on future earnings that are going to catch up. Just like you said, it was 300 at one point.
Mm-hmm.
That eventually that catches up because their future earnings are expected and it's happening, and they've boom, they've proven through it. So I look at the overall markets and I'm like, all right, you guys think I'm the pessimist on the panel. Only thing I can say is I do know.
Do you disagree?
No. I'm an optimist. All my career, I'm an optimist. I bought stock in 1984 before you were born, Eli. I love the stock market. I'm a huge fan of the stock market, but I also I look at numbers just like you do. You're data driven, and you can kind of look. It's kind of like looking at the Buffalo guy that got the first down on one angle, but didn't look like he got the first down on the other angle. You can look at different angles and make any argument you want to support what you're saying. And I'm looking at like, well, yeah, I'm a little more pessimistic. And the other thing of that, Trump is coming in. He's incredible business oriented. And this is where I think he can, like over a long period of time, over the next 4 years, I think the market's got a lot of room to run, but it might take a little bit of time to unwind some things. And so, for example, I know this is, beating a dead horse, but the price of gas, right? Just us getting more gas friendly, pumping more gas, and that not just petroleum, but natural gas and so on, will help the economy immensely and will help the inflation problem a little bit and will help the lower class and middle class and those things. But that will take time for that to kind of seep into the market. Mm-hmm. Even if we do wonderful things with that stuff over the next
we all get
6 months or so.
I think just human nature is we all get so captured by the booms and the busts, right? Those are what grabs our attention, right? Those years in the market, the 20, 30, 40% up years, the 20, 30, 40% down years. Mm-hmm. And so that's almost like become the expectation of it's one or the other, right? And flat, kind of normal, what you might call a normal market, like up, plus or minus 10% is not necessarily common. Like the market does historically move in kind of a big way. Right. But it's also not super rare. Like you have periods of time where the market just kind of moves sideways for a while. Sideways in it may be down 10%, maybe up 10%, but you still kind of consider that like a relative sideways market. And so I think there is a scenario where, hey, it's not like, to your point, like it's not that the market has to like crash, right?
Right.
Like we've had a couple big years and now, it's just inevitable. The market has to crash. We could see continued growth. We could see earnings growth. Some of these names start giving up some of the, the valuations, PE ratios get pulled in, and the market still kind of grinds forward a little bit and just kind of moves sideways for the next year or two. And I would, if you gave me that as an option, I'd be like, rubber stamp, I'll take it.
Back 20%
exactly.
Right?
Exactly.
And so it's not that that's the most likely scenario, but I think that's a very realistic scenario that the major indexes, there's a lot of volatility within the indexes and individual names, but the bottom 470 stocks, 480 stocks actually do kind of pretty well. Yep. And then the top 10, 15 maybe pull back a little bit. And when you
just slow down. Just slow down. Yeah, there is value. There is good value. I'm looking at healthcare stocks and financial stocks, and there are sectors of the market that are, I think, going to do really well over the next years that have not necessarily done well over the last several years because of the tech kind of taking over the deal, But I'm optimistic, even though I sound like I'm pessimistic. I just don't think this, like to your point, I don't think the skyrocketing market can sustain forever.
Sure.
You eventually get to the point. And the expectations of these stocks is so high that every quarterly report, people are going to be hanging on the balance of, did they meet last quarter's, growth, or did they meet last quarter's? It's kind of like Netflix has just gone through the moon, right? And they've done a few things they're upping their prices, their subscription pricing and all that kind of stuff. They said that their last meeting. And so it'd be interesting to see how their next quarter compares to their last quarter. Are they going to continue to grow at the pace they are? And if they don't, will that just make a sell-off on that stock, which has done really well? That's my point. There's more opportunity to miss because we're expectations
we're priced
are so
to
high.
Perfection.
Yeah, we're priced to perfection.
Or
I hope that continues perfection. But
so yesterday kind of brought out all of the people that I really love to follow on Twitter, and there's some stuff that they posted that I think is really worth talking about. Most of it can be summed up with 3 words: rotation, rotation, rotation. We're starting to see, this is what looks
That's
to
one
me,
word said 3 times.
Oh, is it really? So it's starting to see just a move in the market, and a lot of that's moving out of the big cap tech, the Nvidias of the world, moving into things like Dow type of companies, Russell 2000, your small companies. Year to date, Dow has outperformed all indexes. Russell 2000 has outperformed the S&P 500. S&P's outperformed the NASDAQ. Basically, a rotation
Reverse.
is the antithesis or the exact opposite of the last 2 years. That's been true of the last 3 months. Dow's up 6%, NASDAQ's up 4.6%, S&P 3.8%, and the Russell up 3.7%. So a little underperformance there in small cap. But you start to look at the rotation, and yesterday, so this is Ryan Dietrich on Twitter. He says, in an alternate universe, these could have been the headlines today instead of the NVIDIA sell-off.
Yeah.
Okay? Financials close at an all-time high. There's been a big movement towards financials.
Yep.
22 out of 30 Dow stocks close higher. Dow's less than 1% from all-time highs.
Yeah.
Apple posts its best day in 4 months. Amazon all-time high. 349 stocks in the S&P up. Momentum is up 7% year to date. Small caps and mid caps both outperformed today and are now outperforming the S&P 500 year to date.
Yep.
So you start to separate what the headlines are saying, and you start to look at other parts of the market. And what this looks like to me, from a young man that wasn't born in 1984, is you take what has been a boom of technology, and you start to say, okay, this big story has started to move away a little bit, and we're seeing some underlying strength just in the overall economy outside of the big cap tech. The problem with that, though, big cap tech is so heavily weighted in the indexes.
Mm-hmm.
Right.
Yeah. It's going to be hard for just the indexes as a whole to hang in there if big tech sells off materially. But it doesn't mean there's not a lot of companies doing really good things, within that. But when you take a market cap weighted index, it's going to get pulled down, right? So
I like what Eli's saying. I think you're right. I mean, I said, financials and healthcare are kind of the areas that I think that we could make a lot of headway this year. But you're right. If these big names do fall off. Now, NVIDIA, let's pick on NVIDIA because obviously they're the story. Like I said, to me, NVIDIA yesterday and the last couple of days of trading, NVIDIA's dropped down below 120 a share. To me, that's a buying opportunity for NVIDIA. So I don't think I think that kind of flash sale like that of a big name like that just creates an opportunity. And so I don't think they're going away anytime soon. I don't feel like that company is going to get, like to your point, 40 PE ratio. Apple got down to a under 16 PE ratio like 10 plus years ago. And it was, people were kind of dismissing Apple for just a little while, for a year or so. And they kind of dismissed Apple and it didn't do very well. And since then, it's had a 5-for-1 split, a 2-for-1 split. I mean, it's like if you had bought Apple right then, you'd be doing really well today. And I kind of feel like NVIDIA, like these big name companies are the best in what they do and the best in the world. I'm not at fear. But going back to 2000 financial crisis, tech crisis, the majority of the fall was companies that had no chance of making it.
Right.
They weren't there. To your point, these are great companies. So if we have a little pullback, that's a natural, almost like healthy.
Yeah, absolutely.
It's healthy. It's okay. And so anyway, I'm not as pessimistic as I'm led to be believed to be. So anyway,
I'll have to think about that. But nonetheless, it was big, big story in the market when you talk about the best performing stock, biggest, name in the market over the last few years. It sells off 16%, loses almost $600 billion. I mean, can you think about that? Loses $600 billion of value in one day. That's wild.
Unbelievable.
It wasn't too long ago when that would have been larger than the biggest company in the market.
Right.
What else? Anything else that we want to touch on? That was the main topic that we wanted to touch on today with the big news, kind of big headlines yesterday.
I reiterate. Oh, sorry, go ahead.
One topic that I think is an interesting thought to go through is if this is an AI boom to an AI bust. Like if we start to go down the world of this is a big bust in the AI sector, this may be one of the most obvious, looking backwards, bust that could have come.
Why do you say that?
You have this huge run up. You have speculation in an industry. You have companies that have just continuously climbed much higher than the rest of the economy, growing to levels that are rarely seen in the S&P 500. And then something comes out. It would just, looking backwards, it would look like,
how could you have missed that?
No doubt.
Yeah.
Well, and but I think it's intriguing to me because what they're doing is it's so important to, like, from having voice automation in, like, I went to a local restaurant and they had a voice automation that sounded real. Like, you have some of those that sound not real, but one that sounded like a real person. And you give an order and you find out that is not a real person. It's AI. Mm-hmm. And then you get to the counter. So it is a local company that's been kind of spreading around the country. Great place. But they're saving money, right? Yeah. They have this AI so I mean, I think the AI is just, even in that sense, right? This little chicken place, right? AI is supporting and helping people, and it's continually growing. And I think AI is not going away, but I mean, the prices of stocks could go down.
I think the best opportunity
down,
in the market over the next 10 years is those who find the companies that implement and use AI the best, right? Because if you go back to a good comparison between now and the dot-com bubble is, the companies that ended up winning were not the ones, this is talked about in some of the stuff we listen to, were not the ones that laid the fiber optic lines and built the Wi-Fi routers and built the nuts and bolts of the internet. It was the companies that figured out how to build a business on the internet, leveraging the internet,
right.
that have, looking back over the last 20, 25 years, have built the best performing companies, the best performing stocks. And so, a lot of the AI market today has been kind of the nuts and bolts of who's building and, like, who's figuring it out. Yeah. But there's going to start to become these companies that say, hey, we're using AI now, and it's helped us not have to hire, the next 1,000 people, and we've increased margins by this, and we've rolled out new technology on this AI platform. And I think those are the companies that are going to be positioned to do well over the next decade.
Yeah, we've seen the horns on the bull market. We just need to find who's got the legs.
Wow.
That's what I was smiling about this whole time.
What
I was
in
just
the
thinking
world?
about it.
I looked at him and he was cheesing, and he was biting his tongue. It wasn't even
wonderful.
that good.
My goodness.
I'll give you a B-. But,
yeah.
If you like that comment, like this video.
Yeah. Okay. Well, we'll have to just stop on that one. But interesting topic. It'll be interesting to see what the market does today. We're kind of most everything's kind of slightly up to start the day. Yeah. So just kind of catching our breath after yesterday's big move. So anyways, as always, we appreciate you guys watching and listening. Give us a like, subscribe, shoot us an email if you have any questions, and we'll see you guys next week.
The hosts of the Market Moment podcast are employees of Mach 1 Financial Group, LLC. Mach 1 is a registered investment advisor located in Rogers, Arkansas. Mach 1 may only transact business in those states in which the firm maintains a notice filing or has qualified for an exemption or exclusion from registration. A copy of Mach 1's current written disclosure brochure is available through the SEC website and available at disclosures.mach1fg.com. Thank you for listening to the Market Moment podcast.